Hello, everybody, and welcome back to another episode of That NextGen Planners Podcast. As always, you are joined by me, your host, Amelia Hamilton, Head of Community at NextGen Planners. But I'm not a singular host. I have my co-hosts. What would I do without them? They ask far more intelligent questions than I can ever think of, with much better people skills. And they should. They're financial planners themselves. They're on the ground doing these jobs. Who are they? You know who they are already. It is Taylor Beavis.
Hello.
And Clara Metcalf.
Hi.
I did it the other way around this time because I seem to always start with you, Clara. And I thought, you know what?
Preferential treatment.
Yeah, give Taylor a go.
Thank you.
But we are not alone. We are joined by another wonderful, wonderful guest in the form of Julian Parrott. Welcome to the podcast, Julian. How are you?
Good to be here. Thanks.
Pleasure to have you. So you work in a really interesting space within financial planning. So to kick things off, do you want to give a little bit of background about Ethical Futures, about what you do, and how it's different to perhaps your whatever a quote unquote normal financial planner does, if there even is such a thing?
Is there such a thing as a normal financial planner? Yeah, it's funny because it's an interesting space, but it's only become interesting in the last 5 or 10 years or so. So I started off when it was a bit of an oddball space. So Ethical Futures, we're independent financial planners. We're based up in Edinburgh. We do what many financial planners do. We do financial planning. We look after probably mass affluent clients, helping them make their journey through life. So that's all pretty, ordinary fare. But it's always done with a values perspective. And I suppose that just comes from, I'm the grey hair in the room here. So, I've got plenty of experience in terms of financial services, and I spent the best part of 10 years in kind of mainstream financial planning advice, working for nationals and such like. And I had my millennium moment on the 4th of January 2000. I had left working for a national, Sedgwick's, and joined a small company that was specializing in ethical investment. And that was a kind of purposeful decision that I wanted to do something on that basis, born out of even then a kind of dissatisfaction with the way the industry was working. It was very much a sales business at that point, so planning hadn't really been invented. But it was also, I worked for a company who had 2 ethical funds on their panel, and once I'd used them, then I had to go back and do something else like the Pru bonds or something. That was the rationale. So I was dissatisfied with that, but I'd worked with clients who were interested, and that sort of piqued my interest. And I'll probably tell you about some of my early clients and some of the idiosyncrasies of working in the sector. But that then led on a few years later to the formation of the founding of Ethical Futures. And when we founded it, there was a very clear decision that that's what we were going to do. We weren't going to sort of try and muddle it along and do a little bit of both, and we were going to be sort of purist in what we did. And at that time, it was just my partner Martin and I, and a couple of days a week part-time administrator who helped us. So we're not a huge organisation, but we've grown organically over that time, and that job's given me opportunities to do other things as well. So and as we like to say, as our business strapline, we make your money change your world.
Nice.
The way I like to explain Julian to other people who had not heard of Ethical Futures is he was doing sustainability and ESG before it was cool, before it was it was the buzzword, before it was this thing that's exciting to get into. It feels like you were at the party setting up the drinks before other people arrived there.
And hats off to to other people out there who who were there before I was, and people like Lee Coates and such like who are out in the sector. But yeah, I was a fairly early adopter, if you like, in terms of the area. And it was, somebody asked me about this a little while ago, and I said, well, it was actually a little bit more interesting and exciting back then. You did feel a little bit more like you were definitely different.
Yeah.
You'd go to a PFS meeting or something, and you'd be doing your sort of cups of coffee and chit chat, and with somebody, and they'd say, "Oh, what do you do?" And they literally would look at you like you'd gone mad.
Speak Spanish.
Yeah, exactly. And they said, "What? You just do that? Yeah. Do you make any money?"
That's so impressive because, I haven't been in financial services anywhere near as long as you have. And I remember when I first joined, was that 2015, 16? Mm-hmm. And it was really hard to build a portfolio of funds that had much in the way of screening, that wasn't sort of just greenwashing or some sort of, token gesture. So it must have been a real struggle earlier on to do that.
But then that kind of speaks to how sort of financial markets and financial planning and the availability of funds and things have changed over the years. Because, back in the 90s, most people invested in a managed fund. That was kind of basically, that's what we'd call a 40-85 now. But, that's essentially what people went into. And they were probably investing in investment bonds, and they had that. And it was probably only later that idea of asset allocation really built into the market and how you actually allocate money. But this was the time when I started. Your diversified balanced portfolio featured the UK equity fund and the global equity fund. That's it. And maybe there was the odd managed funds as well, but there were no corporate bond funds. There were no sector-specific funds. International was international. That was it. And the only sector-specific was UK equity. And I think might have been a UK equity income and a couple and UK, all companies. But that was the palette with which you had to paint with.
We're spoiled for choice now.
Yeah. So you had quite an exciting ride to see this all develop, haven't you? Has it developed how you would have wanted it to in terms of the industry, to where we are now? Has it gone down the right path, do you think?
Well, things evolve. There's a danger of grey hairs saying it's not like it used to be, and that's it. So choice is better, and the opportunity and the access is better. So those are all good. I think it's become a very sophisticated investment market, and I do sometimes think that there's an element of that which is quite removed from what the client experience is and what the client still brings. I can't give you any details because we're halfway through the client survey, so I don't know what the responses are. But we're reaching out to our clients to do a survey and find out about what it is. But clients, and you'll know because you speak to clients, clients speak a different language.
Yeah.
They don't talk about science-based targets unless they're an environmental consultant. We do have quite a lot of those, so they can keep me certainly right on that, and I be careful what I say to them in case I overstep the mark in terms of them pulling me off my knowledge. But most people talk in fairly generalistic terms about what they're seeking to achieve. And then there's that aspect about whether or not the market's evolving. So, I think it is good because there is a lot of sophistication in there, but I do sometimes wonder whether some of the sort of core value pieces of what clients are bringing to the table are achieved. The one area that I would really have liked to have seen development on, but to be frank, I don't see it happening because it's a very difficult and hard to invest in sector, is what I would call real impact. So there's a talk about impact and secondary market, and there's all the stuff on SDR and such like. But I actually like putting money into the ground, into community projects and funding to what, my pound really adds an additionality to what happens and changes. But generally we put a big barrier up there that says, this is high risk, don't do it. Only do this if you want to lose any of your, all your money, or you've got, allocate 10% at the most and such like. I think it's that element of sort of change.
That's how it's developed. And do you find that, you mentioned that's all you do in the company in terms of that is your philosophy, that's how you do things. Do your clients have differing, I guess they do have differing views around some things. So do you cater for clients that would like to be maybe a darker green and a lighter? How does that work?
Yeah, so that is one of the myths around the marketplace about people being, it's a homogenous group of, sandal wearing, muesli eating, I think that is dying a little bit of that sort of imagery, but that certainly was, how it's at. And so my anecdote around that is that, way back in the 90s when I was doing this, and I had unexhausted my 2 panel funds for a client, And I was allowed to go and research funds. So I went off and diligently sort of researched this fund. Very excited about these funds I was going to go off and recommend to this client guy. Now, he was, what was he? He was a scientist, and I had to go and see him by visiting him in his life sciences center. So I went through the safety gates where the metal alarms were there, because there was a time when PETA were very active and there was a lot of anti-animal testing activity going on. So I'd go through all the safety networks and everything, go in and see this chap in his laboratory and chatting. And I was talking avidly, and probably indicated where my values came from, and was very motivated by sort of social issues. I was saying, well, this fund does this and that. And he said, Julian, I don't care what people do to each other. I'm just interested in the environment. That's so I was going sort of lesson learned. Clients don't all play into all the same aspects. So to answer your question more directly, we took a view that our role is as guides to help people navigate what is a very complex world, and has become more complex as the market options have evolved. So we, our questionnaire starts with a big black box. Yeah, and so what's important to you? So we get a verbatim comment from clients. So we use that, and then we'll usually send that out to somebody, and then unpack that with them when we're having a meeting to actually discuss exactly what they mean and whether or not our social enterprise is actually investable in the context of the investment they're going to do and such like, and these things. So we've evolved a pattern that sort of reflects ideas of how a market is, or how the market is structured, and therefore how they might fit in. I'd like to say that the FCA has sort of taken up quite a lot of my ideas and, sort of followed sort of good practice, but in terms of that, and I've fed that sort of rationale into other people I've worked with in terms of actually how you approach it. So we recognise people are different.
So you do cater for that. It's not a one size fits all. It's a preference.
Yeah.
Nice.
But it's sort of, but have some values.
Yeah.
Care a little bit about what you're doing.
So there are a lot of buzzwords that float around, impact investing, values-based investing, and screening, exclusions, all of that. Can you sort of give us like how would you explain the difference in these as if you were speaking to a client, maybe not necessarily an advisor? Because I think a lot of financial planners really struggle with communicating all these different styles to their clients. So how would you go in and try to kind of explain what the difference is between all of these words that we hear flying around?
Okay. So, I think first off, it is very helpful to get something out of them in the first place to say kind of what matters to you. So you actually got some sort of position to work from. But effectively, we will explain that the investment market has developed a variety of ways to review an investment opportunity and to create an investment portfolio and to try and ensure that your investment is still achieving your objectives or meeting your values, perhaps not so much objective, but meeting your values in that respect. That has evolved over quite a number of years in terms of a range of different styles, in terms of how we might approach that. And we can use those as individual approaches, or we can layer them up. So if we go back to the traditional approaches, which came out of religious and strong sort of value action type oriented organizations and groupings. So you're thinking about sort of Quakerism and areas like that, and you're thinking about into the 20th century, into things like campaigns against apartheid and Vietnam and such like. You started to see investment funds being created which were about avoiding some of the worst excesses. And therefore, you can create an investment portfolio which is founded upon exclusion, and exclusion is sometimes tempered. So it's tempered by a percentage or a proportion of the amount of exposure to a particular area you might have. So a company might be 95% doing the right thing, but have a small stream of income, and there's decisions as to whether that's tolerable. And that's where the market's at for quite some time. But it's evolved over time. And the first thing was to say, well, okay, we've screened out the bad, but what am I left with? So if we've just taken, this is the portfolio now. Do I just invest in these companies, or do I then put some rationale as to where I'm allocating my money and why? So then you develop that development of positive themes. And quite commonly that sits around things like healthcare, education, renewables, public transport, variety of other concepts and things, efficiencies and such like. And so that your money is avoiding the worst to whatever degree that you're comfortable with, and then allocating to something that's a bit more positive. Now, this works in the equity space, in the investment market space, but not so much in the cash market space. But once you own investments in businesses, particularly shares, then you have a seat at the table. So then as an investment manager, then you can go and speak to the management of the business. You can engage with them. So it's a terminology called engagement, which means that you can push for positive outcomes. You can improve their reporting, challenge them, or push for better diversity policies, etc. Or indeed, you can challenge them on things that they're doing wrong. And your ultimate approach is to say, well, if we are unhappy with the way you run your business, then ultimately we will divest. So we will take our money away and reallocate to somebody else, which, depending on the size of your business, may also send a sign to the market as well, and a signal that we're unhappy. But so it won't necessarily rock the boat, but it might to a degree. And that has been the core of where the market has sat. And I suppose over the last 10 years, what we've then seen is further refinement of that. So then you get looking at investment funds which focus on particular issues. So if you're interested in climate change, then you may well be interested in having a fund that focuses on that, or focuses on a particular type of sector within that. So renewable energy or transition companies or something of that order, people that are trying to reduce their CO2 emissions, etc. And the latest sort of kid on the block, if you like, is what we'd call impact. And that's where you're trying to measure the outcome. Now, that's still to a degree not fully tested in terms of how it operates, but it's putting a mechanism around a business or investment opportunities to create measurable assessment of what changes that's achieving. And quite often that would then be aligned to something like the UN Sustainable Development Goals, which were set up in 2015 as a means to bring more private money into global markets to affect change across 17 different goals and about 167 sub-goals. So there's lots of opportunities there, which companies then try and align to. And our job as financial planners is to help navigate that route for the clients.
Sort of signpost it. And how do you, on a practical level as a business, with all of these different factors, how do you construct portfolios? So do you find that you yourself are running the portfolios, or you can my question really is, does the market have enough in terms of off-the-shelf solutions to cater for most of the needs, or is it very bespoke?
So we as a business took a view, 12 years ago at least, that we weren't investment managers.
Yeah,
and that we were started to tie ourselves up in knots, creating bespoke portfolios with clients on things like co-funds and such like, and running it through the old Iris spreadsheet and looking at that and getting a response. The Iris spreadsheet, which if you gave the client the opportunity to tick every box, meant you end up with one fund or no funds were available to choose. So we had then introduced a ranking order for clients so that they couldn't say they're all important. We had to sort of weight them and position them. But I mean, I don't think many financial planners have come to this view as well these days. But we decided that we weren't experts in terms of actually trying to manage a portfolio for a client. So we've evolved away from that. We do pick funds for our smaller value clients. One of our sort of completely unadvisable, most financial planning gurus will tell you completely not to do this. But we like speaking to people and ordinary Joes and people without too much money.
Yeah.
So we do run some sort of multi-asset portfolios for clients when they haven't got a lot of money, and by not a lot of money I mean sort of, somewhere in the sort of £30,000 to £40,000 sort of zone or whatever of that order. But by and large we work in in an outsourced basis, and we've been doing that a long time. But for even longer than that, we ran with clients' bespoke portfolios with discretionary managers.
Okay.
So if it's pay to play. If you've got enough money, then you can focus that completely down to
really drill down
to and sometimes they're not even rational in terms of the decisions, but people maybe see a share being bought and then they have a connection or a perception of that, and then we'll have a discussion with the investment manager and decide whether or not that should be a hold, having sort of considered what the research is. So that's the sort of ultimate goal, is to be able to have that discernible bespoke approach. But for most people, that's not particularly viable. So the fortunate thing is that the MPS market has now expanded dramatically.
Yeah.
We like to think that we still take an active role in understanding where investment funds lie, though. So I don't know whether it's just because we're a handy call in Edinburgh to start off the day for some people, but we're still very fortunate in terms of getting investment managers coming to visit us to talk about funds, even though we don't buy them direct as an asset, so they don't feel it's a waste of our time. Probably they know we've got the ear of some of the leading sector, managers in the area.
Yeah.
But we do like to do that due diligence, and in other work I've done in sort of consultancy roles, I've spent a lot of time doing due diligence anyway, speaking to investment funds. So I think it's important to actually understand what the managers do. Our view has always been that I may not agree with every holding that's in your portfolio, but if I understand the rationale for why you're holding it, then I'm in a position to be able to explain to my clients why that's there, what the approach is. And I think you need, to some extent, to eyeball people in terms of that, to understand it.
I think that is a good place to take our little interval. So we'll be back with Julian in just one moment. Hello, I hope you are enjoying the podcast so far. Just a little note from me about some of the brilliant things we've got coming up at NextGen Planners. First of all, we have Good Stock in September, which is our brilliant sustainability conference. If you want to know more information about that and ticket information, you can find that on our website. We have also recently launched business membership, which is very exciting. This is for forward-thinking firms, and it offers a comprehensive suite of tools, training, resources to propel your business forward. And of course, we have our brilliant community, which is filled with amazing content covering all aspects of financial planning. You can find out more about all of these things at our website, www.nextgenplanners.co.uk.
Welcome back to the podcast. So before the break, we were just finishing up talking about how you would adopt the approach of sort of ethical investing in a firm, and how you specifically do that. I want to ask you, so for other financial advisors and planners who want to follow a similar path, but maybe they're not as interested in the deep technicalities of it, or they're worried or a bit scared about doing that. Talk to me about what your approach for them would be, or your advice. Would it be that you'd advise them to kind of, in my head, get to grips with how to pull out from the client what their preferences are, and then you mentioned outsourcing, to go to somebody and ask them for help with constructing the portfolio? Is that a middle ground that you could take, or what would your advice be?
Yeah, I mean, I think there's a couple of things, and I think I spend quite a lot of time when I'm just networking and in sector meetings and such, like talking to advisors who are in a more mainstream sort of role. And I feel that for some people there's a confidence issue about asking the question and understanding it. So it's a bit chicken and egg as to what's there. So I probably, if you're interested, spend some time just understanding, and you can do that desktop reading just to understand sort of, it's basically how are funds run and what do they do. Go and speak to some managers, go and understand, watch the webinars and understand, what they're doing. But yes, I think the issue is around sort of getting to an open question type scenario as to, I haven't got the perfect question, but as to what the client, or if the client is interested in an area. And that, to a certain extent, might just come around from fact-finding. It might just understand things that they're interested in, or activities that they do. But I think it can be presented with a positive or a negative, can't it? We can do some values-based investing around this. Would you like to do that, or should we just move on?
Yeah.
Or I've got to ask this question. Tick the box.
Depends how you ask.
It depends how you ask, and so I think that's an element of sort of confidence. So it's about probably being on the front foot and saying, well, actually, if you are interested in adding, aspects of values to your investments, then that is possible. Is that something that you would be interested in? What would be important to you? I think probably at the outset, it's probably quite useful to put it out in a questionnaire and actually see if somebody responds to it.
Yeah.
And then that gives you something to leverage off.
Yeah. Yeah.
So, is to actually find a format that puts that in and doesn't put it down just as a tick box.
Mm-hmm. Mm-hmm.
But yes, you will probably understand from your client base as to what are the, what are the hot buttons for them. If there are going to be things, it might be around, just what they tend to do. Some people sort of focus in certain areas and certain sort of businesses and involvements. So I think it's difficult for me because I start from the basis that this is what we do, and therefore it's there. But I think that the other aspect is perhaps the comfort area for the advisor. And maybe, therefore, the issue for them is to think, well, I would be reasonably comfortable presenting something that was doing X or Y. There was an ESG, there was a light touch investment portfolio, and I understood that meant get governance, etc. But it might not satisfy, the real deep greeny type client, and then you have to make a decision as to whether or not you want to be able to accommodate for them.
This all leads me into my next question quite well, actually, and that is, I'm opening up to both of you, Taylor and Clara, as well. But looking at, money is power, and it has huge influence. Yeah. As individuals who manage people's money on behalf of them, how do you think there's any kind of obligation or responsibility to present ESG and all of the things that go around it in a positive light in order to encourage people to put their money in as quite a good a place as possible? And this is to all of you. Do you think that as an individual in this profession, there is some kind of responsibility to do that?
I think I'll start.
Yeah.
I think there is a responsibility to present it fairly. I personally don't take the view that I would tilt them to it if they hadn't. Yeah, but equally, I feel that probably even just myself, being honest, based on our chat today, my communication could probably be better around the topic. So I think that if the communication was better in terms of what these issues are and how they could have a portfolio that does this, probably I'd find my percentage of clients in these portfolios would increase. So I think we have a responsibility to understand it and then communicate it in a fair way. What do you think?
I've had a lot of conversations with this about with friends in the planning space. There are so many different opinions on this. Some people think you should start from a place of our essential investment proposition is, screened, and there is an element of some sort of impact investing going on there. If you don't agree with this, we can find you the mainstream. So that's almost like the one end of it. And then you've got people who I think are very scared, don't actually understand the topic very well themselves. I've heard people say, you're having to sacrifice a bit of performance for this, and it's a bit like charity. And I'm thinking, well, it's not charity. And
make it seem more risky almost.
Yeah, they kind of hype up the risk on it, and you're thinking, but these are risk-graded portfolios you're talking about. We're talking about a moderate investor in a moderate risk, ethical portfolio, or whatever, however they want to call it. But it's about the language that they're using. They call it ethical. We spoke about this earlier, and how it's not just about, the planet and solar farms, but it's the stories that some clients understand. So they really focus in on that. But actually, we're talking about the impact on people, the impact on governance. And I think it was Clem, actually, who gave me a really insightful comment once where she said that, like you were saying earlier, if you sit on the board, if you are operating a fund where you've got a lot of the shares of this company, you have a seat at the table to challenge them and question them. And actually, these bigger companies like Shell, when they're doing things that are a little bit questionable, actually is it our responsibility to have a seat at the table in the first place to challenge them on it, because otherwise they'll delist and they'll go and do what they want anyway. So in some ways you have to be involved to some extent. And yeah, I mean, I've saying to you actually about with there are some companies out there who will say, you can go mainstream, that's fine. We will offset the carbon of your portfolio to make sure that we're doing something if you are not comfortable with it. What do you think about that?
Yeah, I mean, that's interesting in terms of that. Offsetting yourself, we could have a whole podcast on that and the merits for. But I suppose the interesting thing is that maybe picking up to Mila's point is how often do we actually ask our clients how interested they are in actually what they're investing in? How often So if I'm investing on a values-based portfolio, whether it's at one end of the extreme or the other in terms of the range of approaches, I will probably talk about some of these things and be aware of how they're allocated. But historically, and I used to be working purely in the mainstream, I didn't open up the portfolio and say, oh, look, it's got VAT and this and that. Isn't that great? Bags make lots of money and get a regular stream from that area. We never talked about where the money was. Yeah. That's partly probably a problem with the old style of financial advice, but that's just still fundamental there. So in a maybe actually coming back to one of your points earlier on, one of the ways you get in is to say, how interested are you in actually where your money's going?
Yeah, just ask them.
Just because from a risk perspective, and people often ask me about where do you position this, that question, as if there's like just one question, but how do you position that question? And I've always thought probably it best sits around about when you're talking about risk and asset allocation and capacity for loss and such like. So how interested are you in how your money's invested? Well, what do you mean? Well, then you could talk about asset allocation. Then you could talk about different asset classes. Then you can explain that actually some people would prefer some of these assets not to be held because of X, Y, and Z. How do you think about that? So again, trying to get to some open questions and bring that out. And then it comes back to money is power. Money is power, and that's the fundamental thing. That's the make your money change your world, rationale. So it's like leverage your money, change what you do in your life and influence it, but it's precision.
I think to your point, a lot of advisors, me including a few years ago, would be worried about what the answer would be from the client, and if I could then work out what I should recommend based on what they don't want and what they do want. And to your other point you made about kind of asset values paying to play, I would then worry about, well, I'm servicing individuals at the lower levels, or what if I don't have a solution for everything they're asking? But I guess my question's on that. So sometimes is there a trade-off where you're saying, your asset value isn't big enough for a discretionary fund manager. It's, we could get a model portfolio. This is the range I've got. Does that tend to be the approach for those?
Yeah, no, it's definitely that. And you have to be candid. You have to be, you have to invite them to a degree of pragmatism in terms of the approach, and you have to tell them when certain things are not possible. Or the attendant risk that's associated with that. If you really want to be satisfied that all of your money is going to a cause which is focused on community projects, organic farming, renewables, community energy, etc., building straw bale houses, then put your money in Triodos Bank, Ecology Building Society, etc. It will be safe as houses, and it will do all of those things. And you'll get a nice newsletter every week or every month that will tell you exactly, what it's funding. But you'll get an interest rate, a deposit rate investment return, and that may have issues. By the way, you can't do that in your pension. You can't do that in you might be able to do it in an ISA, but there will be limitations to actually how you can do that. So there's an element that says, okay, the regulator sees, and we're directly regulated by FCA, so the regulator sees us as independent financial planners, bracket specialism. Okay, we can work in the sector that we can hold ourselves out as independent, but we can work within a slightly more limited universe of investment funds that meet our clients' requirements, etc. So we can say, well, the regulator tells me I need to be your financial planner. I'm accountable for whether I'm assessing, your risk and your capacity for loss and all that sort of thing. So I'm trying to put the values base within that context.
Yeah.
And I think you have to be honest and you have to say, so I have clients, that big open box, it has a never-ending range of joy for me to read the things that are in there before I go into the meeting. And it's no transnational companies, right. No American companies. I want to invest in social enterprise. Tidal energy is where I want to put all my money. I want everything. Why don't I have everything in 100% renewables? So, your job as a financial planner is to be the trusted advisor, is to be, the wise counsel, and to bring your knowledge and your ability from a planning perspective, from a regulatory perspective, from a risk and assessment perspective, and to communicate that to people in terms of trying to understand what their goals are and their objectives are and such like. And just explain, I'd explain to somebody, no, she couldn't, but she could go and buy a woodland with a SIP, but no, she couldn't actually go and live in it because you actually can't live in it because if it's a woodland and a SIP, it actually has to be an investment project, investable commercial project. And you can't live in that woodland. And by the way, the woodland has to actually be able to generate some revenue and not just be set there aside just to grow trees and have a diverse range of trees, So, it is, and I think it just depends on your attitude. I mean, 20 years ago, coming out of a, fairly traditional sort of national IFA background, that was all a bit, but I thought, actually, this is interesting.
Yeah.
Let's look at some of these things. Let's look at rootstock catalyst of, investors and all these sort of weird and wonderful sort of community investment projects. Let's look at this, let's look at that. I've grown up with the development of the market, so I've evolved with understanding how that's gone. So, I bread and butter for me. I eat, sleep, and drink it. So I'm interested.
Your thing.
And I am, I do eat tofu. I do read The Guardian. I am woke.
Granola.
Me too.
Yes. And there's woke's about being nice to people. It's about caring. So I see it as a badge of pride. It came from sort of Black America as a point of a positive response. So.
I guess the term's weaponized these days.
The terms is weaponized. So it's I'm engaged in those areas, so it is a bit easier for me. So I think if you really are not engaged, then you probably just need to go and say, well, I understand that. But what I would urge people to do is to recognize that you are there in an advisory capacity to help somebody make their decisions. And if you can't help them make that decision, then you need to step back.
Yeah.
Yeah, you have to know where your limits
You have to know where your limits are.
Yeah, because it's all about getting the right result for the client at the end of the day. So if you're kind of at the limits of your knowledge, you need to know when to maybe collaborate or hand over. I mean, because you've got this specialism, do you find that you get a lot of clients coming to you who maybe have recently inherited a load of money and they've got climate anxiety or just sort of social responsibility anxiety? What's your experience of that?
Yeah, great Aunt Ada had an investment portfolio and it's full of these investments and I need to sell it now. That's quite common. I've just inherited this and it's got a shell in it. I must go now. Sell.
Yeah.
And you hold on, it's got a shell in it. It's also got a big fat capital gain in it, because you haven't done anything for the last 3 years because you've been sitting there worrying about it. So you need to, take that perspective. But yes, money brings with it its own traumas and troubles and such like. Turning around the tanker type thing. Investment portfolios, you can change them, you can evolve them, especially if they're big enough and you can manage them. Then you can do that. But But that's not an uncommon thing as intragenerational gifting. Recently had a lady who's inherited funds. She benefits from a life trust, and that's sort of her late husband's funds, and she hasn't chosen to do anything with that. But her father's passed away, and now her father is no longer with us. She now feels comfortable in starting to do something with it that reflects her values. Until that time, she felt that she better just deal with how Dad had wanted it, invested. If you do your job properly as a financial planner, you get to know a lot about your clients. I sometimes feel it's a little bit of like a confessional experience and what yours is like, but if you people do open up and talk to you. There's at least 2 clients that I'm the only one, well, probably not the only one, but one of the few that actually know they're married.
Yeah. I get a lot of that.
Yeah.
Or that they're not married, but everyone thinks they're married.
Yeah. Because they finally took a decision on a tax position or something else like that.
Yeah.
So we are privileged, and therefore we're privileged to be able to understand and we do need to be able to emote a little bit in terms of that and understand, whilst keeping that sort of professional distance and understanding it. But I find clients who can be quite worried. They've inherited money, and they perhaps depends on their circumstances as to what they want to do. Some cases it's an aspect of stewardship. They've inherited it. They would like to benefit from it, but they also need to help the next generation, and they want to steward that money in a way that reflects their concerns about the world they invest in. For some people, it sits as a very heavy weight on their shoulders. And I can think of at least one client that I've got for where she's not a happy lady. She's an elderly lady. She's had this money for quite a long time. We've been through rounds and rounds of opportunities to think what we do. Come back to one of your earlier points about, whether it sits properly for her in terms of achieving all her objectives. And it's, you kind of feel, well, maybe we should just give it away, because it's, you're obviously not happy with it, with this money. So I think, people tend to say, oh, you've got money, and financial planners deal with people who have always got, wealth, so everybody must be happy.
We know that's not true.
So
the Rothschilds that had the massive house that he said it's like being alone in this entire building, and it's just a big show. They often say those are the most money are often the saddest.
It was really eye-opening to me as an advisor, like starting to see how the increase in wealth did not change really the happiness around their life generally. I've got a question for you in relation to the future. Yeah. So how do you see, kind of there's 2 parts to this that I was thinking as you were telling me stuff earlier on. So what do you see the future being in terms of how we construct portfolios for individuals? I've seen, I won't mention names, but I've seen a platform that has started doing kind of like custom indexing. I don't know if you've seen this, where you can like really drill down. So is it going to go more in that direction where we can serve lower value clients and really niche into what they want? So there's that part of the future. And then in terms of the other part of the future, I'd like you to talk about in relation to the larger companies, BP, the Shell. Should we be divesting away from them or sticking with them a bit because they have the money to fund the next generation?
Yeah.
What's your thoughts on
that? Yeah.
Podcast, but
no, that's fine. I think the custom indexing is interesting, but sometimes I worry that the technology and the clever clogs gets too far ahead of where people are. I get a wee bit disappointed that sometimes when I go back and see my clients and I do a review and I maybe have some great pictures and charts about impact and whatever else is, they really want to be talking about their grandchildren or so whether they're going on a holiday and what their plan is for when they retire or something like that. So they've almost got there, done it, achieved that, seen the financial plan, I've got the values-based proposition, I trust them, it's all tickety-boo, it's going on fine. And I think to a certain extent, the custom index aspect is a little bit of that. I think the technology is there. We can produce that. People can get it on their phone. They can do all that. How engaged are they? What's the audience for that?
Yeah.
And how long before they just stop checking the app?
Yeah.
That's not to say you shouldn't do it, And I've come from a world, partly just because of the way the industry's evolved. I've come from a world where I tend to favour active and still have slight sort of questions around in our sort of ESG world around how you achieve things and how you achieve real engagement and such like on X areas. But I think that's good because it should be about empowering. And I think we actually sat down and had quite a heartfelt discussion in the business, because we don't have what I call a drawbridge. We don't have an entrance level for our clients. We try and engage with everybody who knocks on our door. We might just point them in the direction of something that thinks right. But it is hard to find that space that engages people and they can do it themselves. And, and to be honest, they probably don't need a plan and doing lots of stuff for them. So that's a good development, but does it offer more than it delivers?
Yeah.
I'm not quite sure.
I'll wait and see.
Yeah, wait and see in terms of that. In terms of, other aspects. So sorry, just run that past me again in terms of the second point.
So in terms of, should we be still allocating towards some of the worst polluters, being that they could fund the future?
It's horses for courses. If you really are uncomfortable with that, with investing in that, I still class myself as a socialist, so I probably would be quite happy not, having capital markets in the format that we have. It just happens that I'm quite good at what I do, so I can work functionally in that role. But I think there's still a huge amount of mistrust in mega corporate power, and that big things like Shell, they're still going to be oil companies, or are they going to be, whatever else? BAT are now the biggest producer of vapes, the tobacco companies are pushing that market. So they just find another questionable area to go into in many cases. I'd rather see renewable community funded and community benefited rather than corporate. But I'm a pragmatist, and I realise that actually big economics is the way to go. But there is quite a compelling story to say that we should work on these funds, and that's probably the role of the pension funds and the big institutions to have portfolios that do that. As an individual, I think that's probably more like saying, I'd like a little piece of that oil and gas action, please. And looking at the performance of some of the investments that we've been holding for clients over the last 2 or 3 years, then that might have been quite an attractive attitude to take. But I don't think for certainly the client base that we work with, we don't see that as something that will float.
Yeah. Well, I've got so many more questions. I'm sure you guys do too as well. It feels like we've only just scratched the surface of all of this stuff. But we've run out of time on this episode. So I'll just say thank you so much for sharing your insights and your knowledge there. It's been a pleasure talking to you, Julian.
It's been a pleasure being here. Thank you.
Amazing. Well, that is all we've got time for this episode of That NextGen Planners Podcast. If you enjoyed this podcast, you can check out all of our previous episodes on Spotify, Apple, YouTube, and on our website www.nextgenplanners.co.uk, where you can find loads more information about our brilliant community. But that's all for now. We'll see you next time. Thank you for listening to this episode of the NextGen Planners Podcast. If you enjoyed this podcast, you can find all of our previous episodes on Spotify, Apple, YouTube, and on our website. Also, there is where you can find even more information about our brilliant community. And finally, if you can, do leave us a review. It really does help to grow the podcast.